Mike Wilson on the Fed, inflation, artificial intelligence.
Early Eastern time for clues about how much the Fed will cut rates this time next week. Concerns are lingering over whether the central bank has waited too long. Mike Wilson of Morgan Stanley writing, until the bond market starts to believe the Fed is no longer behind the curve, growth data reverses course and improves materially, or additional policy stimulus is introduced, it will be difficult for equity markets to trade with a more risk-on tone. Mike is with us around the table. Mike, good morning to you, sir.
Good morning. How are you?
I want to pick up on that quote, and we're doing great. I want to pick up on a line that you're focused on. The difference between Fed funds and the front end of the yield curve, Fed funds in a 2-year, and that quote, how important is that?
Well, that's a signal that we're getting from the bond market. The bond market has historically been a pretty good indicator of where the Fed is relative to kind of what they need to be doing. And we saw this, by the way, on the upside, too, right? In the 2021 timeframe, the 2-year got ahead on the upside. So it's the same picture just on the other side. And you know, people complain, they don't complain, they say, well, look, the stock market is behaving fine, but that's not true. Internally, once again, you know, defensive stocks are really doing extremely well. So I think the stock market is taking its cues from what the bond market is saying. It's not saying hard landing yet. What it's saying is that growth has continued to disappoint. So since April, and we've been on this program many times since then, I would say that the data has been distinguishingly negative in terms of growth data. Also, the labor data has been much worse. So how has the equity market dealt with that? Well, it's pivoted from what I call quality growth to quality defensives. And we made that pivot in May, and that's classic late cycle behavior. So I think everything kind of sinks. It's just we're waiting for the, you know, like, can somebody give us the keys to the test? You know, the cliff notes, whatever it is. Like, how's this going to end? And we don't know.
But the market, ask you, don't you? I'm going to ask you. Basically, you've said we need one of two things. Either the Fed cuts aggressively, or the labour market starts to improve and improve quickly.
That's right.
For equity markets to perform well. So have you got a base case? Is it one or the other? Do we get one or the other?
Well, what I would say is that the Fed could get ahead of the curve if they decide, but the problem, they're constrained. Okay, they're constrained by two things. Not inflation, by the way. Inflation's over, as far as I'm concerned. Inflation, they
Thank you, Mike Wilson. Thank you, Mike Wilson. We might not agree on a lot last year or two, but hey, we definitely agree on that.
What the issue is now is the currency market. If they come in and start cutting aggressively, the yen-dollar relationship is going to create some stress. So they got to be careful with that. The other thing I would throw out there is, we've looked at this, when the Fed starts a cutting cycle with 50 basis points as opposed to 25, the chance of a soft landing goes down materially. And they know this. They know this data. They don't want to signal that. So they're in a tough spot. The Fed's in a difficult spot. They've done a good job of trying to navigate this challenging, different environment that we've been in for the last several years. But now the markets are pressing them. And so next week, I don't really care what they do next week. What I care about is how the markets react. How do the markets behave after they're going to do 25 probably, and then what do they say in the press conference?
The vibes, whether they actually work for the market or not.
That's right.
I'm curious, though, before we go into quality growth and quality defensive and what that actually means, you said something about the currency differential. Are there certain target levels that you see sort of unwinding some of the longs that still remain out there? Do you have a sense of just how disruptive the ongoing long trade?
So, I mean, yeah, you can say there's risk to doing a 50 right off the bat. There's so much risk to doing a 25, including to Jerome Powell's legacy. If they could do 25 and we get a big recession, everybody is going to be looking at that and saying, dude, you had all the signs. Inflation was dead. The labor market was starting to face weakening. You had a lot of companies complaining about their businesses weren't strong. And you went 25 off the go when there was a 300 basis point gap between Fed funds and where CPI was? Ooh, boy, that's going to be rough, right? That's going to make the Fed look really bad. At least if they get out here and start it with a 50 right off the bat, then you could say, okay, the Fed's serious about getting these rates lower. 25 is, it's just signaling like, we've got all the time in the world. And then all of a sudden, it proves not to be right. And then you look really wrong.
Dollar really will be potentially down the road.
Yeah, I mean, I don't have a specific level, but I do feel like they're trying to defend this low 140s level between yen dollar, so call it 142. If we start to, 130-ish, 138, 139, I think that could cause some stress in other markets.
Meanwhile, you talk about shifting from quality growth to quality defensive. I've struggled with these monikers quite a bit, simply because what does defensive, what does growth mean? Where does Nvidia fit into this? Where does the tech trade go, given the fact that people have gotten an AI trade that is so inflated in terms of expectations and timing? What does that mean to you, quality defensive?
Defensives are your classic defensive sectors, whether it's utilities, staples, healthcare, things that are positively correlated to bonds. Okay, they did not trade well, by the way, up until sort of April. It was really the quality growth stocks. Now, the other thing that's happened is the AI dream has taken, a little bit of that luster has come off. And I really gauge that by what semiconductors are doing. It's not just Nvidia, it's semiconductors writ large. And a lot of those stocks have really come off. And that makes sense to me. We just got overcooked on the whole AI theme. It doesn't mean it's over. We've written about this extensively. We're not believers that this is going to change productivity materially in the short term. That's a long-term story. And everything kind of got bid up on that. So with that theme now gone, the market is looking for a new theme. On a growth side, there isn't one. So what it does is it hunkers down into defensive, high-quality assets until we get the next thing. Whether that's a bad outcome or a positive outcome, they're going to hide out in these areas.
Mike, you say inflation's over. We do have CPI data, though, today. So I'm curious to know, how do you think the market would trade if we get, say, a hotter print? Say, is it too volatile? Or softer print? Would the market start pricing in 50? Or look at a softer print and say, wow, we are cooling down faster than even the Fed was expecting, and bad news really is bad news.
Yeah, well, when I said inflation is over, I mean the rate of change on inflation is over, and it's kind of over for equity markets, and quite frankly, it's over for the Fed. Where inflation is not over is the price level. Right? The price level is absolutely squeezing the heck out of businesses and consumers, and so it's like a vice. And so I don't think inflation is over in that regard. But what I would say is that a hot number, I think, is probably pretty bad for the stock market today. I'm not expecting that, but if we got a hot number today, then all of a sudden the Fed is going to stay behind the curve. They're kind of stuck. If we get a really soft number, then we go back to our old thesis, which is pricing power is gone. Okay, so we kind of need to thread the needle here a little bit too. I mean, break evens are at 2% now. Break even. So what are we talking about? We're already at 2%, and it's not like these things stop on a dime. They have there's a risk that we undershoot on the downside. That's good for bonds and it's bad for stocks typically. And by the way, that's how the stock market, that's how the markets are trading. So I think the markets already understand all of this. Once again, they're going to do something next week to try and manage the situation. 25 is what we think, and they'll signal for more 25s, not 50s. And then what do they do with the balance sheet? I think that's probably the bigger wild card. Do they talk more aggressively about ending QT more quickly? Do they find other provisions to provide liquidity? That's the bull case, in my view. That's where we could be surprised on the upside. Is there more liquidity coming into the system from other sources?
And after
next
next
week,
week,
the Fed has been reducing their balance sheet considerably for really, honestly, it's been about 2 years now at this point in time or so. They've brought it down by, last time I checked, it was at least a couple $1 trillion.
everyone's going to really be focused on the U.S. election. Goldman Sachs, RBC, they talk about how earnings will be much higher potentially under a Trump administration if he gets his tax cut plan, rather than Harris, who's calling for 28%. How do you view next year earnings growth based on these two proposals?
Assuming that the economy is in a soft landing, okay, that the Fed hasn't overstayed its welcome, and by the way, I think that risk is still on the table. We're in the soft landing camp, but that to me is way more important than the outcome of this election in the next 6 to 12 months. So let's assume we're in a soft landing. Our view is the same. We think that basically Trump is kind of pro-growth, kind of bad for bonds, good for stocks, okay? And that's how we would look at it. And by the way, last night when the debate was going on...
Wait, say that again?
Election in the next 6 to 12 months. So let's assume we're in a soft landing. Our view is the same. We think that basically Trump is kind of pro-growth, kind of bad for bonds, good for stocks. Okay. And that's how we would look at it. And by the way, last night when the debate was going on...
Which means exactly the opposite would happen.
And the betting markets kind of went in favor of Harris, and the stock market futures kind of traded up a little bit. Okay. But I do think the stock market is pro-Trump. I mean, the stock market has traded better when his odds go up and vice versa.
Mm-hmm. So bonds are good under Harris and stocks are bad under Harris?
In theory. I mean, at the margin, I would say that's the setup. And the reason being is really taxes. Taxes is the one thing, and that requires some congressional support too. But to me, that's the big issue, not tariffs so much. Both administrations have tariffed. And then immigration, I think both parties are going to have to deal with that in some way. So taxes is the issue. Obviously, Trump is talking about cutting. Harris is talking about raising them. That's bad for stocks, good for bonds.
Wanted to ask you this question. I want to squeeze it in.
So Trump isn't necessarily great for the market, and I think that's what investors got to understand. people could make a argument that Trump's great for the economy, right, or for jobs, or for the average person, things like that. Like, if you want to make that argument, you can. But I can tell you, as somebody that experienced the Trump presidency in the market the full time, with a lot of money invested, right, he's not always good for the market. There's a lot of different reasons for that. He's very volatile. We all know that, right? And so he can, flip and change his mind on something real quick, and it cause a lot of volatility in the market, right? He can do tariffs, trade wars, those sorts of things, cause a lot of disruptions in regards to a lot of big global companies, and that creates volatility in regards to their stock prices, in regards to their business models. It creates disruptions and those sorts of things. And so you got to understand, like, in Trump's first term, he got the 15 percentage point drop in corporate tax rates. That's not coming if he gets a second term. That's not coming. He's not going to be able to even touch corporate taxes this time around. So you got to understand, 14 percentage points of Trump's gains in the stock market when he was presidency was just from getting, at least 14 percentage points, was just from getting corporate taxes down from 35% to 21%. That's not happening again, right? And so when I look out there, I know a lot of people are like really excited. They think the stock market's going to boom under Trump. And I'm just here to tell you, like, don't get too excited about that, okay? As a lot of people get too sad and disappointed over certain presidents, they think, oh, the stock market's going to do horrible. Like, a lot of people could have thought the stock market would be trash under Biden, right? Stock market's done pretty dang good under him, right? And so a lot of people, people run to these conclusions with just not understanding like what's actually going on underneath the market and the surface in regards to these sorts of situations. So, don't get too bullish. Don't get too bearish on who's going to be president or who's not going to be president.
Brian, Lisa was knocking on the door. Are utilities actually defensive? They're up like 20% this year.
The issue is people get so emotional when it comes to politics, right? I'm able to not get emotional because I don't vote. But so many other people, they vote, so they get so emotionally attached, and it's like rooting for their football team or their basketball team, and they think like we're going to win every game, right? And they think the other team's the devil, and they're the worst, right? And in that emotion then overflows into their opinion on how they're feeling about investing in the stock market and all sorts of things. And dude, anytime you are wrapping up your emotions with stock market, or anytime you're even thinking about like this president's going to be good or bad, you're already lost in regards to stock market. I can promise you, as somebody that's been doing this 16 years, I think that was one of the points I made in that great video I released last week on the main channel. What was it called? 16 years of stock market advice in 52 minutes, right? I think it was one of the points. Like, if you're lost if you're making your investment decisions based upon who might be president or who might not be president, or who's going to be president and who's not going to be president. Like, trust me, it doesn't work the way you think it works. Trust me.
Feels like everyone's getting whatever they want from utilities. It's defensive. It's attached to AI. What are utilities?
So this is a very interesting question. So, we agree. I mean, we don't think we were one of the first ones to talk about utilities as an AI beneficiary back in February, March. I think that's probably gotten a little overdone, to be honest. But now utilities are definitely trading with the bond market. So the defensive properties of utilities are, I think, dominating their performance in the near term. Here's the interesting thing about utilities. Their balance sheets are not great. Okay, so you got to be really careful with utilities. If it's going to be a hard landing, these things are going to start trading really poorly. So I would caution listeners, if utilities start trading really poorly and the stock market's not ripping, that's a bad sign. That would be a sign that, we are actually getting closer to potentially hard landing risks. That hasn't happened yet. But if you look at things like low volatility parts of the stock market or defensive, they've gone almost parabolic. And if they start to sell off hard without a stock market rally, then I get concerned about hard landing risks. That's not the case today.
Interesting. Already Mike Wilson. Mike Wilson's a little bit more playing it. I would still say, after watching that, do I still feel like Mike Wilson's more of a bear than a bull? I would say yes. I feel like he's still more on the bearish side than the bullish side. But I will say he's much more even keel compared to how he was certainly in 2022, 2023 when I would react to his videos. Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you looking at in front of you right there? That's the 6-figure Hall of Fame. Do you want to see the next one? That's the 7 8-figure Hall of Fame. Now, that is my private group. Those are members of my private group that have scaled to 6 figures, multi-6 figures, 7 figures, multi-7 figures in their stock market portfolio. They say you are the average of the 5 people you associate with. If you're somebody that is having trouble finding other long-term investors that are focused on building their wealth over the coming years, finding like-minded folks, look no further than my private group. We got a tremendous amount of people. We're consistently talking with each other, learning from each other, researching companies together, sharing news about our different companies, right? We do all that inside my private group. If you would like to apply to join us in there, go down in the description area. There'll be an application down there. You can click on that and you can apply to join us in there and take your game up to a much higher level and associate with the type of folks that you actually want to associate with.
Alrighty, next one up here. Brad Gerstner speaking about big tech rotations of money, where it's going.
And see you. It's good to be here. Good to be here.
There were two moments, I think, today. You know, the markets were a little rattled, and Jensen Huang was on the stage downstairs and just continued to talk about AI and the great demand that he's seeing. David Solomon, as I said, sat with us and said things in the economy look pretty good. You were sitting in on the Jensen conversation. It's now your biggest holding, isn't it?
It is. It is. I mean, as you know, really going all the way back to January 23, it's been among our biggest holdings. It is our biggest holding today. You know, there's been a lot of concern over the last couple of months whether or not there's an AI air pocket. Satya and Sundar got on their calls and said it's more important to overinvest than underinvest at this moment in AI. But we heard a few things this week, Scott. Elon Musk and Sergey Brin down in LA earlier this week at the All-In Summit both said that the pace of AI is faster than any other tech development they have seen in their lifetimes. Yesterday, Dario from Anthropic was here.
Yes, but that's not surprising. That's not surprising. And here's why. Listen, we've never been in a point in time where companies this large, this successful, with this much money had an opportunity for the next big technology and could invest into that heavily. That's why it's moving faster, right? Because the companies with the biggest pockets, Microsoft, right? OpenAI with all the money they always are raising, right? Obviously Meta, Google. You look at all these different companies that are investing so heavily into Nvidia chips, these companies have the most money. They're doing the most. And so we've never really seen that. Like if you think about like the internet age, I mean, companies were little babies back then. So they were investing small amounts of money and they were raising capital for this thing called the internet. And we're going to have a website and do all these sorts of things. But it was small money. You didn't have big pockets coming in to really invest in that, right? It wasn't like, companies had tens of billions of dollars to just throw at new internet related stuff. That wasn't the way it worked, right? It was a very small investment compared to this AI chip investment. So that's why I think it's moving much faster, because these folks have so much money, it's ridiculous.
Scott from Microsoft was here saying that, demand is continuing to outstrip supply. We heard the same from Thomas Kurian. So when Jensen took the stage for Nvidia this morning, he said nothing's changed. Of course, there was some concern about a Blackwell delay. He took that off the table. He said Blackwell is on target for Q4 ramping and scaling of production. So I think that as we look at 2025, we're at about $5 a share for Nvidia. It got as low as $100. That's 20 times earnings for the most important company in compute today. So I think that, people are starting to lean back in to some of this big tech ahead of the election.
Is that when you made it your largest position?
So here's the issue, right? I think if anybody's really educated on this space, no one's concerned with 2025 numbers for NVIDIA. Everybody should assume NVIDIA's numbers are going to be great for 2025. That's not the concern. The concern is 2026 and 2027 and how is demand looking there, especially if we have a weakening economy over the next year. And you have all these big tech spending every dollar, it seems, on these chips, right? Who's to say if their businesses start to see some real weakness that they might pull back on spending at the end of 2025 and in terms of their orders for 2026? That's very much a realistic possibility, right? If at the same time, around 2026, 2027, you start to get more, let's call it serious competition from AMD, okay, now we could actually talk about price compression, and we could talk about margin compression for Nvidia at that particular time. That's something, I don't think enough people are factoring into this whole story in regards to that. So that's what's going on with Nvidia. It's not like, if anybody's concerned about 2025 numbers for Nvidia, they just aren't very educated on the space. 2025 is going to be great for them. We've heard Meta, like all these companies have basically signaled that they're going to spend even more on the chips in 25 than in 24, right? But what about 26? That's where the question marks really come up, and that's why you see, Nvidia stock having a tougher time, because people are thinking, especially in regards to growth stocks, they're not just thinking about the next quarter or the next month. They're also taking into account the next year, the next 2 years, the next 3 years.
During that disruption a little more than a month ago?
We added a bunch to our position, almost doubled the size of our position when it was disrupted earlier, in August. And again, it's been very volatile. I think we'll continue to be volatile while people await that print in Q4.
But how are you thinking about the return on investment, right? I mean, you alluded to...
Q4 is going to be great. Q4 guidance is going to be great. No question.
The concerns in the marketplace about all the money that's being spent, the CapEx up 40 or 50 or even more percent.
And that's why I said there's still a potential Nvidia could hit, as I've said this entire, before we even, I think, went into this year, I said there's always a potential Nvidia could hit that 150 to 200 range this year. And how it would get there is you get a risk on market, right? And simultaneously, you get those great numbers with a blowout guidance, and then everybody's going to be back on the Nvidia train, right? But that still doesn't fix the question marks about 2026 and 2027. So it's something that has to be considered. And so all of a sudden it's like it's a major pump. Everybody gets in, everybody's excited to the moon. And then after that, you got the downfall.
Annual basis. At what point, though, do we really need to see the fruits of all of that cash?
A critical thing to remember is Nvidia is not just in the business of generative AI. Right? What Jensen has reminded us is that we're going to have to replace the $1 trillion of CPU-driven data centers. This is stuff that drives things like data processing, everyday workloads, in these data centers. And so you have $1 trillion over the next 4 years of generative AI workloads that we're going to invest in, and $1 trillion of CPU replacement that we're going to invest in. And so I think you're seeing incredible returns. He said this morning, for every $1 invested by the hyperscalers, they get $5 out of the generative AI workloads. He also talked about data processing. He said for a company like Databricks, they can drive down the cost of data processing by 95%. Their operating costs on a certain workload goes from 20 million to 1 million. So I think this, the red herring about ROI here is one that Wall Street spends a lot of time thinking about. But when you look in the boardrooms of all the hyperscalers and the big enterprises, they're all leaning in and investing.
The other thing he talked about that I thought was pretty interesting was a lot of what we hear when folks talk bullishly about Apple. He talked about their installed base.
You got to understand, it's very easy to lean in and invest extremely aggressively. One, when you're in a very exciting cycle, right? The first few years of a new product, offering that's very exciting, right? Secondly, it's very easy to invest extremely heavily in something when what? Your stock price is going up, right? And if you look at pretty much all the big tech companies for basically the last 2 years, where's their stock gone? Up and up and up and up and up. And so their revenues have been looking great, their profitability's been looking great, and their stock prices have been looking great, right? And so at the end of the day, they can really spend as much as they really want on these AI chips in the short term, right? But if at some point, and let's say in 2025, those stocks start to go through a tougher time, I can tell you there's a high probability they'll pull back on spending. And you just see that consistently over time. You see that consistently. We every single time these stocks all of a sudden go through a period of drama, a period of down cycle, they stop to invest so heavily in different things they're up to, right? And they pull back on the spend. We saw that from a lot of these companies in 2022, right? We saw that from Amazon. They started watching their spend aggressively. We saw that with Meta, right? And look at Meta's spend 22 to 23. It was down, exponentially. And so this is just, some food for thought in regards to that.
Not only on the gaming side, but on now the supercomputing side as it relates to AI. And it got me thinking about the way people talk about Apple. It also goes to the question of moat versus first mover advantage.
Right.
Right. He implies that he thinks they have a moat because of that installed base.
Yes. Well, I mean, when you think about the stack, this is no longer a computer chip. Blackwell has 7 different chips in the system. The system is the entire data center. And so the advantage, he also talked about CUDA. A lot of people point to CUDA as a moat for NVIDIA. But he said 100%. CUDA is just the beginning of our moat. We have 350 libraries that sit on top of CUDA. These are things like CUDA IO and CUDA DN that are specific algorithms targeting things like data processing or image generation or things like recommender models. And so I think the width of the stack is one that is much greater than people think. And he said the only thing that really competes is Google's TPUs. And he actually gave a pretty good shout out for Google's TPUs this morning.
Okay, I don't know why they just cut it out there. Okay, so, NVIDIA's just, at the end of the day, NVIDIA is one of those stocks that I look at it and I say, it's a rather easy hold, I think, for the next 10 years. It's a hard hold for the next 10 months. That's what I'll say about that. Because in the next 10 months, we'll see. We'll see. There's a lot that's going to be very interesting and transpire in this next 10 months, right? We're obviously going to have the election. We're going to have the inauguration. We're going to have, do we get that recession in 2025 or not, right? We're going to have where do big tech stocks head at that particular time. I mean, there's going to be a lot. Then there's going to be questions about, okay, who's in office and what are the probabilities of getting certain things done versus not. There's a lot that's going to happen in this next 10 months. I can tell you that. So that's why I say it's a hard hold for the next 10 months. I think it's an easy hold for the next 10 years if you obviously want to be invested in NVIDIA, right?